I highly believe that you got to have some skin in the game. You got to have some experience in an asset class before going big. And maybe that means buying small multi. I mean, it's not that much different. It's just more at scale.
If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Druin. What is up, everyone? My name is Matt Druin. I'm the host of the Go Big Live Real Estate Investors podcast. I have today Mr. Andrew Freed. Like many investors, Andrew's journey started with a book and an epiphany. I wonder what that book was. After years in the corporate America rat race as a project manager, he realized that a 40-year journey to retirement wasn't the only path. Why not take a risk? Andrew currently specializes in multifamily properties in the Worcester area and has helped countless people also begin their real estate journey. His passion lies in to teach others about the power of investing and financial literacy. With experience in a broad range of real estate sectors, Andrew has a lot to share with the Go Big Live audience. Thank you very much for being on the show, Andrew.
Thank you for having me. I'm happy to educate your audience and provide value.
Excellent. All right, so let's dive in. The first question I ask all the guests on the show is, you were born and now you're here. What happened in between?
It's quite a broad question, but what happened in between was I sought the American dream just like my middle-class family taught me to do. You know, go to a good school, get a good education, work at a good company, get a six-figure job, you know, get a swanky little condo in Boston in a nice area, right? Like I did all of that. And by 30, I still felt empty, right? I felt like I had some lost potential. I felt like I was always meant for something great. I just didn't know what it was. And I escaped and procrastinated myself into video games, into movies, into whatever I could to escape that, you know, when you come home from a job every day, that sinking feeling, right? So, and then I finally read Rich Dad, Poor Dad, as you kind of alluded to. And, you know, at that point, tears are going down my face. And, you know, I'm really understanding kind of what I needed to do next. And that was to seek financial independence through real estate. And that's exactly what I did. You know, I looked at my Mint app, I looked at my net worth, and I bought $250K in net worth, 200 of which was in that one-bedroom condo I bought in 2015. So I decided to take out a HELOC on that one-bedroom condo, and I used that as seed money to start buying all of my multifamily. I did my first with a house hack, with a HELOC money and house hack, so technically no money out of my pocket. Then I got into a syndication with my HELOC money, which cashed out a year later. My neighbor wanted to sell his property, three family, got that with HELOC money and stock money. So I got that one for like 40K. And then, just started partnering on bigger stuff, you know, splitting larger deals with people, 5, 6, 7 plexes. Then I accumulated up to about 30 units that I own with partners. I own about 20% of that. I'm happy to talk about that tactically. And then I recently just closed my first syndication for 65 units in New Bedford, Massachusetts. So now I'm about at 95 rental units.
Oh, awesome. No, that's a great story, especially with, you know, a lot of people feel stuck right now that I can't buy a house because the market is so crazy. You know, we have a housing shortage throughout the country, and there's this huge untapped resource of HELOCs, because one thing that a lot of people across the country have witnessed is increase in their home equity. And people really carry that as like a trophy, like, oh, my home is worth this and I owe this much. This is how much wealth I have. Well, if you don't tap into that home equity, it's dead equity. And you need to activate it if you're really serious about growing your wealth. And that's an incredible resource that I used. It was, you know, how I bought my third and fourth deal. And it is just a huge untapped resource of capital. So that's awesome for you to really lean on that as part of your story.
Yeah, I mean, you bring up a lot of good points. And I think the main big point that you brought up, which is key to building wealth, is return on net wealth, right? Mm-hmm. So most middle-class Americans have their net worth in 401k, in their primary residence. Like, what dividends does that pay you every single year? What yield on your money does that pay you every single year? If you're trying to reach financial independence, you know, you need like $2-3 million at a 4 or 5% dividend rate every single year, then you can live off that every single year. But if all of your net worth is trapped up in debt equity that doesn't provide any dividends, that's when it's time to do a reallocation through refinancing, through HELOCs, through cashing out your 401k. And that's exactly what I did to kind of leverage my assets to buy real estate.
All right, awesome. Andrew, we were in the green room talking about identifying that one deal, the big deal, the big scary monster deal that we want to use as a case study for this show, because we're about tactical, actionable tips, those slick tricks, and also the pain that was involved in it. So you have a deal fresh in your mind. So let's talk about that. And well, first, let's back up a little bit. What was, you had 30 units. What was that sort of seminal moment where you're like, I have to do bigger? Because that's a big jump from where the type of deals you were doing to this recent deal that you just did.
It's funny because I wasn't even looking for that, but it came to me, right? And it actually came to me because I put years and years of work into creating a brand, into networking, into hosting meetups, into becoming a subject matter expert in multifamily in my area. And as a result, one of my partners that I did mastermind with, he got a 65 unit portfolio under contract in New Bedford, Massachusetts through a direct mailer, and he didn't know how to take it down. And the first person he thought it was Nick. So he called me, and that's how I learned about the deal, and that's how we eventually took it down. But it was all through relationships. It was all through networking. And it was something that when I heard about, it scared me, but I knew I could do it.
Yeah, it's that, there's one to many, which is marketing, and there's one to one, which is sales or direct relationship building. So it sounds like you put intention into building a thought leadership platform to be known as a subject matter expert. And this is what I talk to my students about all the time, is that you have to it's sad that notability is more important than credibility these days, but it's just a fact. And so you can be the greatest, most credible, ethical, hardworking person in the world. If nobody knows what you're doing, you're going to be out of business very shortly. And if you're not expanding that audience as well. So where did you learn that or get inspired by that? Because that definitely was not in the Robert Kiyosaki book.
That was not. I mean, Bigger Pockets was instrumental in kind of guiding me on exactly what to do. I mean, I just listened to Bigger Pockets and I did it step by step. Underwrite a certain amount of properties every day, walk a certain amount of properties every day, house hack, start a meetup, read every real estate book you can, go to as many meetups as you possibly can. I just did that every single day in, day out on a consistent basis. And that's what really built up my kind of brand. And then the other thing that you mentioned is become a subject matter expert, but within that, it implies that you have to choose a niche, right? So the niche that I chose was Worcester multifamily. So I became the Worcester multifamily guy, and that was who I was, right? I went all in on only Worcester multifamily. I became an investor-focused agent. I got a mentor, and those are the things that really kind of allowed me to scale.
Yeah, that's the weird thing about, you hear this thing, the niches, the riches are in the niches. And one of the things is that when you develop a niche one of the reasons why people are afraid to develop a niche or however you call it, is that, oh, well, if I'm in a niche and I'm known as this guy that does this thing, this specific thing, then there's other opportunities out there that might be the opportunistic that won't come to me because I pigeonholed myself into this. And what I found is that, when you develop a niche, people will associate you and your brand with that niche, and then you'll get stuff that's outside your niche anyways in terms of opportunities. It's just the way the world works. With what you did and the meetup, you didn't see a 65 unit deal coming to you, and that wasn't your niche, but you were known and top of mind, not just being real estate guy, but multifamily Worcester real estate guy, that a 65 unit in New Bedford could come to you. So that's awesome. That deal came through from a relationship and a mailer that was off market. So kind of take me a step further from there. And this thing came to you, you were scared by it. What were the next steps after that?
So the next steps were to convince me and my partner that we could take it down first, which he came to us primarily for capital raising, but me and my partner also bring a strong asset management component. We self-manage all of our properties. Mm-hmm. So next steps were walking the property, getting in every single unit and walking every single unit and coming up with a comprehensive CapEx plan on, what are we getting at a price per unit? How much is it going to cost to stabilize this property? What are we getting it at an all-in cost per unit? How much are we getting for rent? based off the cap rate, does this thing make sense long term? Like those were kind of the initial kind of thought process before kind of getting it under contracted.
So this sounded like was it a scattered site deal, these 65 units?
That's exactly correct. So I actually had experience in this particular asset class because I did small to medium multis. I personally own, 3 to 6 or 7 unit properties. And these were all about 12 properties ranging from 4 to 8 units, all clustered, majority right in the downtown area of New Bedford. Yes.
So this is something that guests in our show haven't encountered. Typically, we're talking about 5 units plus that have specific appraisal standards that are different than residential 1 through 4. So how did you account for, because that a 4 family in there was not going to be, you weren't going to have the same part of the plan, or had to account for that differently than the other ones that you could just basically force appreciation through boosting NOI. So how did you kind of go through that?
So we found this sale through a direct mailer and estate sale. They were actually just going through the estate sale right now. Like they couldn't sell the properties until 6:30 because all the tenants had first right of refusal. So with the estate process, they actually did an appraisal on the property. It came back $1 million higher than what we paid for. So we knew initially we were in, this thing would appraise all day. That wasn't the question. And then you brought up a good point. A lot of syndications are not done buying clusters of properties. So we took that into account in our business plan. And the way we did that was we negotiated with the bank for a partial release clause, allowing us to sell each property off one by one, yet still keep the loan, right? And why that's critical is because when you can sell these off one by one on the open market, you're going to get a way higher dollar per unit cost than in a package deal or in a commercial sense, right? So that's kind of the strategy we took, and we all had experience in this asset class. Between all the GPs, we have, probably 400 or 500 units in this sort of asset class. So,
absolutely. So let's talk about the total capital stack on there. What was the acquisition price?
The acquisition price was $5.75 million with a $250K seller credit.
Okay, $250K seller credit. Was that something you asked for from the get, or was that based after doing some due diligence and finding some skeletons in the closet?
That was based off walking the property and negotiating with the seller based off these capital expenditures. This is what we're going to offer. And we set it up as a seller credit so we could bring less money to the table and the bank would bring that money. Absolutely.
So now let's talk about how is that capital stack from there was rehab involved, right? Did that $250,000 account for all the rehab and the value add, or no?
Good question. So we actually budgeted around $500,000 in rehab costs, mostly unit renovations, a couple new roofs, and some other capital expenditures like plumbing and things of that nature. We negotiated with the bank, and this is always key. I mean, if you're buying a commercial property, you should always consider this. We negotiated construction money. So the bank brought us, I believe, an additional $300K of construction money, along with our $250K seller credit, encompassed our full CapEx. In addition to construction money, you should always be asking for an interest-only period to allow for an easy stabilization. So on this particular deal, we got a 5.65 interest rate, a 2-year interest only, 30-year amortization schedule with a $300K line of credit, construction line of credit.
Excellent. So let's talk about the raise. How much equity you had to raise for this deal?
So we had to raise about $1.8 million. And that's where a lot of these struggles derived from, was the capital raise. Because to be honest with you, I bought everything else with my own money. Like, I never asked other people for money. So that was really awkward for me initially. I mean, I got over it, but it didn't come naturally.
Yeah. So for those of, we have a lot of listeners that live in Rust Belt towns like Rochester, New York, and we're used to our like 20, 25% down on deals. This sounded like it was more than 20, 25% down. Why was that?
It was 25% down, but we also had additional money for the operating account, and also closing costs with syndications and attorneys. Like, the closing costs get ridiculous. I think our closing cost was like $150K or some stupid number. So.
Oh, damn. Okay. So you had to fund an operating account. You had some additional, like, heftier closing costs. So that's why that 1.8 was on the higher side. I get it now. So I don't know, like you had a meetup, you had a thought leadership platform. How did you go about like hitting the pavement on raising the dough for this deal?
Great question. So I was really lucky in the fact that I think 3 or 4 months earlier, I ended up getting on the Bigger Pockets podcast
Mm-hmm.
as a guest speaker, and that kind of established credibility where actually people like believed in me more. I don't know if that makes any sense, but it really did. I really felt it. So at that point, I made a list of about 150 people. It was me and my partner, Zach Gray, a great guy. We ended up doing the capital raise primarily together.
Mhm.
So I made a list of about 150 people that in my network that I thought would invest. And during the due diligence process, I called 3 people every day and talked about this opportunity. And over a month, I talked to 150 people. And at that point, I had a good sense of kind of how much money we could raise. But what I will say is when somebody says they're going to give you money and they actually wire the money are two different things, right? And that's what happened. That's what were some of our challenges, which I'm happy to talk about, but that's kind of where a lot of our challenges derive.
Okay. So yeah, let's keep on this. Let's keep on the, I have a bunch of questions on that because yeah, that's the other thing is that when you get a soft commit or even a hard verbal commit, like getting people to write that check, what are your sort of like knowing what you know now, what would you do differently? Because I've been in that scenario too. I've had investors that were like, I had half my raise allocated to one investor and I was like, all right, my job is going to be easy now. And then when it came to actually, wiring those funds to our attorney's trust account, they like ghosted me. So tell us about that.
Yeah, I mean, I think it goes back to the point of like, if you're gonna raise, you should really raise like 2x, even 3x sometimes, because people are gonna back out. From based off of my experience, I probably had about 50% of people back out for me. I mean, it differs per capital raise. I mean, I think my partner Zach, like most people went with him. Like, so it depends on trust. It depends on who you talk to. It depends on your network, right? But I would recommend you at least raise 2x the money for the deal, and then who come first serve, or maybe you prioritize past investors. But yeah.
So this is actually a benefit and a curse of this being a live show. We have Barrington in. He's a member of our live studio audience. Barrington, can I stop your video right now? And I can have you come in? Okay. Jess, you can keep that in the podcast, by the way. So Barrington, we're going to get to our live Q&A after we go through the story here. So that being said, you had some people back out. How many people did you actually have to bring in to participate with this deal to take it down?
Well, we had to bring in 0.8 million at minimum 50K. So what is that, like 40 or 37 or something like that?
Mm-hmm.
But we ended up closing with, I think, 14 or 15 investors. Some people brought larger sums than other investors.
Yeah, so
and sorry, I did forget to point out, it was a 506B, so it was all kind of family and friends.
Okay, family and friends. 150 people. Like, how did you develop that list?
How did I develop that list? I went through all of my email contacts. I went through all of my phone contacts. I went through all of my social media contacts. I went through my CRM of past clients, anybody I interacted with. I just literally anybody I knew, like literally anybody I knew, I put in that list, right? And I just started reaching out. And yeah, I mean, some people didn't respond, other people did, but I just started 3 people a day. And sooner or later, I got to that list pretty quickly.
So was this picking up the phone or was this started with an email? Tell me about that.
It started with an email. I just asked them, hey, how's it going? Do you have any interest in investing in real estate? And if they did, I'd be like, I got a cool opportunity. You want to jump on a phone and chat about it? Or I'll text them about the deal or whatever. In addition to that, we also developed a marketing package.
Mm-hmm.
We hired somebody on Fiverr. And we put a marketing package together for the opportunity as well. So that also helped.
Order of operations started with an email. And then did you blast this out via email and then started contacting 3 of these people per day through this due diligence process?
We were early. We were very early in the stage. So I was just texting people and chatting about it. As we progressed in the due diligence period, and then we started hiring syndication attorneys, then we started getting a formal package together. So it was 2 stages. One was getting a feel. And then the other one was actually like, all right, like here's the package, here's the docs, can soft commit here sort of thing.
Yeah. Now, so you had this deal under contract, and did you start that right from day one then when you got involved with this deal in terms of, hammering those contacts? Or was this something kind of in your mind that you thought you were going to do before? Or was this kind of like, oh crap, I'm doing this, I have to do this?
It was, oh crap, I told them I could raise this money. Can I really raise this money? Like, I'm going to put action to my words and start hitting the ground running. Like, because I've never done a deal like this before. I honestly, I never raised money on a deal. Like I said, I used HELOC money for a lot of my purchases, right? So it was completely foreign to me. My partner has raised money before, so that was reassuring. But yeah, it was definitely like an oh crap moment for sure.
Commitment breeds creativity, like Uncle G says, Grant Cardone. I've been there, absolutely. So let's take this step further. You had an SEC regulated offering, a 506B, meaning that you could only do it based upon people that you had relationships with. So what was the actual structure from, did you have a preferred rate of return? Did you have some type of equity split, waterfalls?
Yes, we just did a 7% pref, 70-30 split, 1% asset management fee, 1% acquisition fee. This was our first syndication. We were trying to be very generous with the returns. So that's what we offered. Yeah.
Excellent. And was this deal cash flowing from day one that you could start distributing the, preferred payments right from the get-go? Or did you have sort of a stabilization period, manage the expectation with the investors that, hey, we're going to get our arms around this thing over the first year and then start distributions? Tell me about that.
We advise investors a 6 to 12 month stabilization period while we change ownership, while we enhance rents. At the end of the day, these properties were going through an estate sale for quite some time, right? So they weren't managed the best, right? So we had to get them up to snuff where they can perform, for sure. And it just provides some context on the portfolio. We would get them for about, I think, $83,000 a unit. I believe average rent across them was like $700, and we underwrote it at 1,100 rents per unit. So 1.2, 1.3% roll, and that's what we underwrote it at. And then we could talk about what was reality. But yeah,
let's talk about reality, man. I want to hear some battle scars here.
Well, what I will say is, so Section 8 rent, fiscal year 20, we closed in August. Fiscal year 24 Section 8 rent came out for 1-bed units in that area, and they actually came in at 1,200. So it was better. We were very conservative with our underwriting, for sure. So yeah, we feel really good about that because the majority of the units are 1-beds. We definitely have some 2s and some 4s scattered there, but majority are 1. So yeah, we feel pretty good about that.
So tell me about the curveballs that happen along the way.
So the curveball that happened along the way, the biggest curveball was the capital raise. We thought we could raise 1.8. We ended up raising 1.1, and we're like, oh crap, what are we gonna do, right? But what I will say is my foundation of what I built in the past set us up for success in the future. And what I mean by that is I established a mentor very early on in my real estate investing career. I ended up starting a meetup for him, becoming an agent on his team, and providing him a lot of value, right? So when the syndication came up, he already owned 500-600 units. He'd already syndicated before. He guided me through the entire process. He's like, talk with this attorney, talk with this lender, this broker. He helped me even negotiate that partial release clause because he's bought portfolios in the past, and that was an issue he ran across, right? But when I came to the issue with the capital raise, I ended up calling his team, and they finished it off. So yeah, that's kind of what happened, but it was extremely stressful nonetheless. At a certain point, in the capital raise, when you're doing your forecasting, you're like, I'm raising this much. By the end, I'm not going to raise it. You got to make a decision, and we ended up, I think, making the right decision.
Yeah. Now, how did that look like? So did you bring on a co-GP as him and his team as part of the general partnership?
Yeah. So we gave him a little less than half the deal to raise the remainder. And they took a role on the asset management side as well. They had an in-house property management company. They owned 500-600 units. So they took a lead on that, which has been very helpful. So yeah, so they definitely brought something to the table as well as experience. So yeah, it's been a great learning experience. And to be honest with you, this was our first syndication, and I think we got a great deal. And I think we would have done great stabilizing it. But it's reassuring to partner with somebody who's done 6, 7, 8 of these already for my investors. Like I want to provide them a great return.
Mm-hmm.
And it's honestly a win for everybody to have somebody more experienced on the team to kind of guide us through the process.
Yeah. So what type of, was this a debt from a community bank or regional bank?
That's exactly correct. And that's actually the best debt in real estate, as you know, is a small local bank, community, small, maybe regional bank, Eastern Bank.
Mm-hmm.
They provided that. Really good terms. We went through a mortgage broker for that. So, but yeah, he got us some really amazing terms.
Now, this begs the question, right? Who was the guarantor? Who had the balance sheet to take this thing down? Because even if you have a great deal, even if you can raise the capital, you got to have a guarantee. You're going to have a guarantor on it. If it's I'm assuming this was either a recourse or non-recourse, so there's got to be some type of guarantor on it. So tell me about that. Who's signing the loan docs? Who brought the balance sheet?
It was recourse debt, and the partners were the guarantors. So we all had a combined net worth that exceeded, I believe, is it the loan amount or the purchase price? One of the two. We were the guarantors. So yeah, and that's why it's key going into one of these deals. It's like you got to have some experience in the past, I mean, especially with real estate. Like I want to see experience for credibility, but also you want experience so you have a decent amount of net worth that you can actually take down a deal like this.
100%. So we're getting a little bit towards the end of the recorded part of the show. Andrew, I wanted to ask you, what is this deal doing for you today, and what has this deal done for your life?
This deal is training me on how to operate on a larger scale and how to delegate the low dollar per hour task and focus on where my time truly matters and where my strengths are. And this deal has allowed me to think bigger. You know, currently I have a 32 unit under contract with some partners as well. And I wouldn't even be going after an opportunity like that if I didn't take down this deal. I wouldn't even think it's possible. So it opened my mind to the world of possibilities that I could actually take down some of these larger projects.
100%. Now I have to ask, my last question is, for those investors that are out there that feel like they're banging their head against the wall, taking down smaller deals, that know they have to go bigger to reach those big goals. I mean, one of them is being financial independence, financial freedom, whatever you want to call it. What are your words of advice for them in going big?
Start with your own money. I highly believe that you got to have some skin in the game. You got to have some experience in an asset class before going big. And maybe that means buying small multi. I mean, it's not that much different. It's just more at scale, right? So that'd be my advice, is to build some credibility, build a niche, and get experience in that asset class. So when you do ask for money, you have some examples to point to on how you made money in that asset class in the past.
What about for those that are kind of stuck in, like, they put their own money into their deals, they got some smaller deals, and now they're looking to scale bigger, and there's usually something holding them back. So what's your parting words of advice to them?
My parting words of advice would be to find your tribe, find the people that are doing these big things and surround yourself around them, and start masterminding with people like that. You know, if you start spending your time with people who own hundreds of units, you soon too will own hundreds of units. If you see what they do on a daily basis and you mirror them, you too will have the success they have.
Absolute gold. Andrew, thank you so much for being on the show. We're going to get into live Q&A with our live studio audience in a minute. But I want to tell you, if you're listening to the show, I'm talking to you directly, and you want to get on live Q&A with absolute beasts like Andrew Freed, Gino Barbaro, Reed Goosens, Brian Burke, Stephen Libman. These are titans here. You can get direct access to them in live Q&A sessions. Make sure to join the Go Big Live Real Estate Investors group on Facebook and get exclusive one-on-ones with our esteemed guests. So, Andrew, thanks again for being on the show.
Thank you.